All right, so please, I was asking if there is any question before we move on to illustration 15. Hello, can I move on? Do you have any question?
On my end.
Can I move on? Hello. Okay.
Yeah, I can move on. The network 24, yeah.
Okay. Okay, so illustration 15. Please, someone should read for me.
Illustration 15. Bosman's factory has a carrying value of 1,200,000 Ghana cedis on 31st March 2014, and it was revalued at 1,350,000 on 31st March 2015. The remaining useful life at 1st April 2014 was 30 years. Required show the treatment of the above.
Okay, so with this one, the revaluation happened 31st March 2015, and we are having a carrying amount as at 31st March 2014. The remaining useful life at 1st April 2014 was 30 years. Now you don't have the cost, you have the carrying amount. That one is as at 31st March 2014. So how will you calculate depreciation in that year, in that particular year, 2015? How are you going to calculate it? Because the carrying amount we are having is as at what? 31st March 2014. But I said that the closing balance for this period, 31st March, will become the opening balance for the 1st April 2014. Okay, so this one, reporting period starts on April and ends on what? March every year, 31st March every year. So this 1st April 2014, okay, we can use this particular figure, 1.2 million here, because that one was 31st March 2014. And that one can be carried forward to 1st April 2014. Because this 1st April 2014 is starting another period. And that is ending on what? 31st March 2015. 2015. So please, I hope you understand the concept. So here, the carrying amount that you determine will be 1st April, 2014. Okay. So that one is your current value. So that one is 1,002. I've omitted the 3 zeros. Now, calculate depreciation for that particular year, accounting year. That is from 1st April 2014 to 31st March 2015. So that one will be the current value as at 1st April 2014, becoming depreciation. So that one will be the 1,002 divided by 30 years. This one is just 1 year, so there's no accumulation here. So just leave it like this. So please, 1,002 divided by this, is it 40? Calculation. You've all muted yourself, so please, how am I going to get the balances?
It's 40.
Yes, it's 40.
Oh, so more. Okay, so please find the difference for me. So this one will be the carrying amount. Oh, yes, the carrying amount.
110.
1160. Okay. So this one will be carrying amount as at 31st March 2015. Okay. And we know that the revaluation happened on 31st March 2015. So we are good to go. We can compare and find the differences because we have to determine the current amount as at the date the revaluation occurred. So the revaluation was 1350. So please, what's the difference? Is it gain to be gain? Yeah. So what's the figure, please?
190.
190. So you know that whenever there is revaluation gain, you add that particular figure to the assets. Because when we were doing consolidation last, that we saw it. So you debit the assets with the gain, then you credit the revaluation surplus with that particular amount. Okay. So let's just go for the extracts. So the extract will be depreciation. So depreciation for that particular year will be the 40. Okay, so 40 negative figure is an expense. So then we go to the OCI. We bring our revaluation surplus or gain of what 190. Then your SOFP extract, you have your non-current assets. That is the factory. The asset in question is factory. Okay. It will be the 1350. So you always use the revalued amount. Stella, you see, this one was the revaluation happened at the end of the year.
Yeah.
So it will be carried in the statement of financial position at what? That amount. So 1350. Okay.
All right.
Yes. Then the revaluation surplus. Revaluation surplus to will be in the OCI. Hey, sorry, I've already recorded it in OCI. Yes. Yes. So this one will be under equity. It's an equity component. So, all right. So equity. Revaluation surplus. 190. All right. So please, is there any question for me? Hello. Please, is it okay?
No question for me.
Okay. Okay. Okay, so let's move on to what's we termed as what? Due recognition. Due recognition. So what do you mean by derecognition? Because earlier on I explained what recognition of an asset is. So derecognition is when the asset is no longer providing future economic benefits, okay, or you've lost control of that particular asset. If that happens, then you have to derecognize it. So in the beginning, I said when you are recognizing it, it means you are capturing that particular asset. You are capturing the information in your statement of financial position. So if you are derecognizing it, it means you have to take out the carrying amount of that asset from your books. Okay. So whenever there is derecognition, one, mostly you have to dispose of your asset. So when you are selling your asset, that's the term, disposing of the assets. Okay. So the recognition of assets is what? This is the double entry. So here we have something called disposal account. So the disposal will be, you debit the receiver, credit the giver. So here you debit the disposal account, then you credit the assets account. Now we are crediting asset account because we know asset is having a debit balance. Okay, so whenever you want to increase that account, you send it to the debit side. But whenever you want to reduce it, you send it to the opposite side. That's the credit side. So if you're having an asset and you want to reduce it, you send it to the credit side. The same way, if you're having a liability and you want to reduce it, you send it to what? The debit side. So this one is just the basics in accounting. Okay. Then the cash received on realization. So that is when you dispose of the assets, the cash that you receive. So when you are disposing of, there are two things. The asset is going out, cash is coming in. So this is what the first case is, what you do to derecognize the asset. Debit the disposal account, you credit the asset account, then it means you've what? Derecognize it. It means that you've eliminate that particular carrying amount from the books, okay, or from the statement of financial position. On the other hand, you are receiving cash on realization. So what do? You debit. What's the mode of transaction or the mode of payment? Could be cash or bank. So you debit the cash or bank. Okay. Then you credit the disposal account. This is just the basics. I know we are not going to use it, but we will need it to do something here. All right, so please let's use the illustration 16 and 17. I think it will be good to go. Then we look at one or two past questions, then we move on to the IAS 40. Okay. So please, someone should read illustration 16 for me. Hello.
Property costing 700.
Okay.
A property costing 75,000 was purchased on 1st January 2014.
This is 750,000 or 7,500.
Come again.
You got the figure wrong, so I was just correcting your figure.
Please read. Please
Okay,
read.
will you continue? Illustration 16. A property costing 750,000 was purchased on 1st January 2014 and is being depreciated over its useful life of 10 years. It has no residual value. On 31st December 2014, the property was valued at 810,000. There was no change in its useful life. On 31st December 2016, the property was sold for 900,000. What is a profit or loss on disposal?
Okay. Thank you very much. So let's start with the costs as usual. Cost is what, 750. Then we will calculate what the depreciation. And how do we calculate the depreciation? Is the 750 over what? The useful life. There's no residual value, so over 10 years. This time around, the asset was purchased on what? 1st January 2014. Revaluation was done on 31st December 2014. So it's the same year. So the depreciation we will calculate is just 1 year. So times 1 year. So we will not write. So definitely that one will give us what? 75. So this will be the carrying amount as at 31st December 2014. Okay. So please, what's the carrying amount as at that date? Then the revaluation happened on what? 31st December 2014.
$675.
675. The revaluation is what? 810. So please, what is the revaluation difference here? To be
135.
135.
Yeah.
So we had done with the first part. Now there was no change to its useful life. So the useful life is 10 from 1st January to 31st December. We've consumed 1, so it's left with what? 9 years. Okay, with 9 years. So subsequently, the depreciation we are going to calculate will be on the revalued amount. So it will be on the 810. Okay, divided by what? The 9 years, because it left is what? 9 years. And the disposal happened or occurred on what? 31st December 2016. So here, this is assets 31st December 2014. So it can be carried forward to 1st January 2015. So as at the 1st January 2015, our carried amount for that particular property will be the 810. That is the revalued amount. So we have to calculate depreciation for the whole of 2015. That is 1st January 2015 to 31st December 2015. That is the first one. And also we have to calculate the second one up to this date. That one too from 1st January 2016 to 31st December 2016. So here the accumulated depreciation will be 2 years. 1, 2. Okay, we have to calculate the depreciation for the whole of 2015 and also depreciation for the whole of 2016. Then we'll get the carrying amount as at 31st December 2016. That is where the disposal occurred. Okay, so now we are going to compare the disposal, the amount we received on realization. Okay, when we dispose of the assets, how much do we receive? How much did we earn? That's 900,000. Then you compare to the carrying amount, the one in our books. In our books, how much is it? And after selling, how much did we get? Then we can compare the two figures to get what? The profit on disposal. And this profit on disposal will be treated in what? The profit or loss account. Because we are saying that this profit or loss should be accounted for in the income statement of the period in which the disposal occurred. So after comparing the carrying amount of the asset as at 31st December 2016 and the disposal amount of 900,000, whether we get profit or loss, we have to recognize it in what? P&L. We have to record it in the P&L. So let's move on. Let's move on. So the revalued amount is 810. So the accumulated depreciation will be So I said after revaluation, we use the revalued amount as our base to calculate the depreciation, not the historical cost. So it will be 810. Then the useful life will be on the remaining useful life, not the original one. So it was 10 years. They said that as at 31st January 2014, there was what? No change to 8 useful life. So we've consumed 1 year out of it. So it left with what? 9 years. Times 2 years, the whole of 2015, the whole of 2016, so times 2 years. So please, what is the depreciation here?
$180.
So please, what is the carrying amount as at 31st December 2016? 630. Now, the sales proceeds, okay, what we earned after disposing of the asset was what? 900. So please, what is the profits on what? This sale?
270.
So please, do you understand? Can do it separately where you earn the current amount here, then you go to different page or different working, then you start 900 minus 630. That will be your profit on disposal. Okay, that one too is fine. Okay. So if you look at a double entry here, you debit your disposal account with what? 630. Okay. Then credit the account, credit the asset with what? 630. That means you are derecognizing the assets here, the property, that particular property. You are derecognizing from your financial statement. The moment you debit disposal account 630 and also credit asset account 630, it means that asset is not part of your assets now because you've lost control, or maybe it's not generating any future economic benefit. So you have to derecognize it. Because when the asset fails to meet that recognition criteria per IAS 16, when it is probable that future economic benefit can be measured, can flow to the entity, and also the cost of the asset can be measured reliably. So when it fails to meet, or when you dispose of your asset, you have to derecognize it. So you debit the disposal account with 630, then you credit your account, asset account with 630. Cash received, okay, you debit it with what? 900. Okay, you debit your cash or bank, whether they paid with check, 900. Credit disposal 900. Okay, now the difference will also be credited to P&L, because P&L, it's, if we say you are crediting some the account or the statement, it means it's either revenue or maybe other income. And we are saying that you shouldn't categorize it as what? Revenue. Yes, put it under what? Under income. That's your after gross profits. You add the other income, discount received, rent received, and all that. You add this profit on what? Disposal. Okay, so please, I think this one is quite straightforward. I think we are good to go. Please, if there is no question for me, let's discuss the last illustration, and when we are done, we look at one or two past questions and we move on to IAS 40, investment. Mostly this standard IAS 16, the question are for FR people, but for you to get the basics in all the standards, particularly the asset standards, you must really understand this particular PPE. Okay, so please, illustration 17. Hey, hello. I'll be doing the talking. So question 2, someone should read and talk. Hello. Someone should read for me, please.
Should I read?
Yes.
Okay. Illustration 17. Property, plants, and equipment and their accumulated depreciation as at 31st December 2010 were as follows. So we have land, building, plants, we have cost and depreciation. The land and buildings were revalued at open market value on 1st January 2011 at 120,000 in total. This was made up of 20,000 attributed to the land and 100,000 to the buildings. The building's original estimated, please move the board small.
You said?
I think there
Okay.
are some, yeah. The building's original estimated life, kindly move the board, of 50 years with a nil residual value has not changed. From the date of evaluation, there were 40 years of life remaining. The directors wish to include the revalued amount, including the depreciation effect, in the financial statement for the year to 31st December 2011. Please scroll down. Plant is depreciated at 15% on the reducing balance required. Determine the amount to be included in the income statement and the statement of financial position as at 31st December 2011 in accordance to the regulation of IAS 16, Property, Plant and Equipment, PPE. All right.
All right, thank you.
You're welcome.
So mostly they will give you land and building, and they will give you the figure for one. You have to determine the one for the other. Sometimes they will give you the figures for the two. Okay, so they've already provided us with the cost and accumulated depreciation as at 31st December 2010. Yeah, and this date, okay, can also be rewrite as first January 2011. I hope you all agree with me. But the closing balance of 2010 becomes the opening balance of what? 2011. Yes. So the cost, we have it here, 12,000, 80,000 for building. The plant, sorry, this is not total. This one is plant. The plant is what? 124,740. The accumulated depreciation is what? Land, we don't depreciate land, so that one is nil. Building is 16,000. Plant is what?
34,740.
34,000. So this kind of amount, as I said, it can also be seen as what? 1st January 2011. So this one will be 12,000. And this one will be what? 64.
Yes.
What about this one?
90,000.
Yeah, 90,000.
So the revaluation happened on 1st January Okay, 1st January 2011. So the same date. So that means there was no revaluation for this one. So that one is still 90,000. This one was revalued to, we are saying 20,000 attributed to the land. So land was revalued to 20,000. Building was revalued to 100,000. So please, the revaluation differences definitely to revaluation gain on surplus. So this one will be 8,000. The gain 8,000 here. 100 minus 64 will give us what?
36.
Okay. So you are saying that you should determine the amount to be included in the income statement for 2011, 31st December. So we have to calculate depreciation for 2011. Okay. From 1st January 2011 to 31st December 2011. Okay. So that one will be the carrying amount or the revalued amount. Answered 1st January 11/11, this will be 20,000. You use the revalued amounts 100 and also what 90. Now the depreciation for the building. Let me use this approach. So building. We know we don't depreciate land. So for building, it will be carrying amount is what 100,000. And let's look at the remaining useful life or the useful life as at that date. Now, the original estimated useful life of the building is what 50 years. And also, from the date of revaluation, there were 40 years of life remaining. Okay, so that one will be divided by 40 years. So for building, 100,000 divided by 40 will give us what? This 25,000.
Yes,
2,500.
100,000 divided by 40 years.
Yes,
yes,
2,000.
2,500.
Okay. So for the other one is what plants. We are saying that plants will be depreciated 15% on reducing balance. And we know reducing balance how it works. Reducing balance is always applied on the carrying amount, not the original cost. So 15% on the carrying amount, 90,000. So 15% of 90,000. That one will be what?
13,500.
So the carrying amount as at 31st December 2011 is what? Land is still 20,000. Building will be
Building
what?
is 97,500. And that is 76,500.
Now 2,500 will be in the P&L depreciation. 13,500 will also be in P&L depreciation for plant. This one will be for building. Depreciation, there is no depreciation for land When you go to the statement of financial position, the extracts, okay, so let me prepare the extracts. So the P&L extracts. Okay, so depreciation. So we have building. We have plant. Building is 2,500 negative. Plant is what, 13,500 negative. Then we have OCI. The OCI will contain what, the revaluation gains. Okay, 8,000 and 36,000. So revaluation surplus or gain. So that one will be the two amounts. Okay, so 8,000 plus 36,000. 8,000 plus 36,000. This ought to be the amount. 40, sorry.
44.
44. Okay. Then the statement of financial position. The non-current assets. So we have 3: land. We have building. We have plants. Land will be carried at what? 20,000. That is the carrying amount. Building 97,500. Plant 76,500. So land is what? 20,000. Building 97,500. Plant is what? 76,500.
500.
Then you go to the equity component. That one will be the revaluation surplus or the revaluation reserves. That is the 2, okay, 44,000. And that one will be 8,000 plus what? 36,000. Okay. So please, do you have any other question? Okay, so let's discuss this particular part's question. As I said, this PP is mostly for FR, but you need the basis, okay, to build your understanding, the asset standards, borrowing cost, impairment, leases, all of them. You are going to need the knowledge of this particular standard. So this one was also asking us to the first topic, subtopic we did, how to determine the cost of an asset. So we said feasibility study is part. So you add this one. Architect fees, professional fees, this one will be part. Site clearance, this one will be part. Construction materials, okay, construction. Now, cost of own inventories used in the construction. We've not treated IAS2 yet, but we are saying that IAS2 is initially measured at cost, subsequently can measure it at cost or lower of cost, and also what? No, initially it's at cost, then subsequently you measure it at the lower of cost and low net realizable value. So this is a net realizable value, 24,000. That is the cost, 30,000, so the lowest. So you choose 24,000 here. Okay, so this one to be part. Internal construction, so this one is part. External contractors, this one is part. Income from renting part of this site as storage depot or whatever, this one is not part. So we are to determine it. So this is the answer. This is the answer. Okay, this is the answer. You see, the IAS2 is applied for first before use on the project. So you use the lower of cost and net realizable value, and that was 24,000. And also, this particular question, if you read it well, this is how you are going to treat it. So let's discuss this one. Please, someone should read it for me. Let's discuss this one so that we end our discussions here. Let me continue with IAS 40.
Okay, so Raiko acquired a brand new property, that's land and buildings, on 1st January 2016 for 40 million Ghana cedis, including 50 million Ghana cedis in respect of the land. The asset was revalued on 31st December 2017 to 43 million Ghana cedis, including 16.6 million Ghana cedis in respect of the land. The building's element was depreciated over a 50-year useful life to a zero residual value. The useful life and residual value did not subsequently need revision. On 31st December 2018, the property was revalued downwards to 35 million Ghana cedis as a result of the recession, including 40 million Ghana cedis in respect of the land. The company makes a transfer from the revaluation surplus to retain earnings in respect of realized profit required, calculates the amount recognized in profit or loss and in other comprehensive income for the years ended 31st December 2017 and 31st December 2018.
Thank you very much. Okay, so this one we've been doing it all along. So first of all, costs on 1st January 2016, 40 million. Land is what? 15 million. So definitely building will be what? 25. So that's what we are having here. Total will be what? 40. Let's look at how depreciation is calculated. The useful life of the building is what? 50 years. Now, you ask yourself, when was the revaluation? So from 1st January 2016 to 31st December 2016 is 1 year. From 1st January 2017 to 31st December 2017 is what? 2 years. Now the depreciation happened on the what? 31st December 2017. That is the end of the period 2017. So we have accumulated depreciations to calculate how many years? 2. So if you don't take care, you will say that it's 1. One will say 2016 to 2017, there's a 1 year. Okay, but in accounting terms, if you don't take care, you get confused here. So I'll just write it down like this. So from 1st January 2016 to 31st December of 2016 is 1 year. Then you ask yourself the date for revaluation, 31st December 2017. So you have to calculate depreciation for the whole of 2017 as well. That is the second year. So the accumulated depreciation will be 2 years. Okay, so let's look at their solution. So that's what they've done here. So we know we don't depreciate land, so it will be dash. So for building, it will be what? 25,000. That's the cost. Okay, if 15, it's 40,000, 40 million, 15 million is for land, 25 million is for building over their useful life of 50 years, times 2, the whole of 2016 and the whole of 2017. That will give you the accumulated depreciation from 1st January 2016 to 31st December 2017. That gave us what? 1,000. Accumulated annual depreciation for 2016 will be what? 1 year. Okay, annual depreciation will be 500 times 2. That gives us 1,000. Okay, so the carrying amount as at the date that revaluation occurred was 15,000 for land, 24,000 for buildings, and the total is 39,000. So the revaluation, we are saying that it was revalued to what? 43 million, 16.6, that is 16,600 for land, and the balance. So if you are having 43,000, 16,600 is for land. How much do we have for building? Hello.
26,400.
26,400. Okay,
Yeah.
so revaluation amount. So that is land, building, as someone said, then add it, you get this. So you find the difference. The revaluation balance, it was what gain. Land was gain of what 1,006. Building was gain of 2,400. Now we are to calculate everything for the years ended 31st December 2017 and 31st December 2018. We've already determined the annual depreciation for that of 2017, the whole of 2017. It will be what? 500, because it was 500 and we added that of 2016, we got 1,000. So for 2017, our depreciation annual one is 500. Now, on the 31st December 2018, there was what? Second revaluation. This time around, it was revalued downwards to 35 million. So we have to calculate depreciation from 31st December 2017. That is the first revaluation. So I've been saying this, 31st December 2017 is also the same as what? 1st January 2018. So you have to calculate depreciation from 1st January 2018 to 31st December 2018. Okay, so that you determine the carrying amount as at the second revaluation date. That's the 31st December 2018 here. This time around 35 million. Include 14 million is what? Land. Okay, so you determine the depreciation charge for 2018. Now, you not depreciate land, building, it will be the revalued amount. Okay, subsequently after revaluation, you determine depreciation on the revalued amount. That's the 26,400 divided by the remaining useful life, because they said that the useful life here, useful life and residual value did not subsequently need revision. So it was the old one, 50 years. We've consumed 2 years out of it. So the 2 years are 2016 and 2017. Okay, so it's left with 48 years. So if you want to determine depreciation for buildings for 2018, it will be the revalued amount, 26,400, over the 48 years. Okay, now, so the depreciation charge for 2018 is now 550. Mind you, the annual depreciation charge for 2017 is what? 500 here, because the question was asking us to find 2017 and 2018. Okay, let's move on. So the revaluation, the second one, 14,000, 21,000, there will be loss, revaluation loss. For land is 2,600 and 4,850 for what? Building. Initially, we have revaluation gain in respect of these two assets. And I've taught you how to do that, the revaluation differences. Okay, I've already let me see if I can find it here. So this is the treatment of revaluation gains. When you get the note, revise. Okay, all right. So initially there was a gain, now there's loss. So you know how to treat it based on the explanation I gave you on Monday. Okay, so the revaluation, so the 14,000, 21,000 will be carried in the statement of financial position as at the 31st December 2018, or for the year ended, the depreciation to be 550 for 31st December 2018. Now, the transfer or excess depreciation. Transfer or excess depreciation. So I gave you simple formats or simple formula. That's what they used here. Okay, you see, is the revaluation gain over the remaining useful life, because it was in the question to transfer that what revaluation surplus to retain earnings in respect of realized profit or realized gain. That's what I've written here. So it is the revaluation gain of that particular asset that we depreciated, and it's only one asset that we depreciated in this question, that is buildings. So you look for the revaluation gain of that asset, 2,400. Here is it. Over the remaining useful life, over 48 years. So it's 50 years. Or you use the long method. The depreciation charge on the revalued amount is what? 550. Minus the depreciation charge on the historical cost, the annual one, 500. It will all give you the 50 they got. Okay, to all give you the 50 they got. But the BM near a shortcut, so use the formula here. Okay, now this is the financial statement. So for 2018, the depreciation is 550. 2017, annual one is 500. Here you are seeing 1,000 because we calculated 2 years times 2. So if you divide by 2, you get 500. Okay, so that's depreciation. Now you are seeing revaluation loss as part of what? The P&L. Normally, revaluation as a revaluation gain should be in OCI. But based on the explanation I gave, treatment of the revaluation differences, where revaluation loss exceeds the positive balance in revaluation reserve account in respect of the same class, here land and building, then any excess loss is treated or debited to profit or loss account. So if you are saying that you debit something to the P&L, it means you treat it as well as an expense. That's why you are seeing revaluation loss as part of depreciation and all that. They are all losses. Okay, so expenses. Okay, so this one should be in brackets. This one should be in brackets. This one should be in brackets. Comprehensive, other comprehensive income. Revaluation surplus of 4,000 in 2017 here. So 1,000 says for land, 2,400 for building. So you get 4,000. That is for 2017. That's why you're having 4,000 in 2017. Then the realized gain, this one, the 50, the one they calculated here, the 50. We solved one example that we deducted this 50 from the total revaluation gain. So they deducted this 50 from the 4,000 and they got 3,950. Okay, they got 3,950 and 3,950. And I've told you that the revaluation reserves can never be what? Negative. So where the excess? Because in 2018, there was revaluation loss. The total gave us what? 7,450. And the gain we are having is just 4,000. Now that 4,000 we've deducted excess depreciation from it. So now it left with what? 3,950. This is your what? Revaluation loss. This is your revaluation gain. The loss exceeds the gain. Okay, so that is why you are seeing revaluation loss of what? 3,500. And how did they calculate that one? Is the 7,450 here minus the 3,950. The revaluation gain, the two, after deducting the realized gain. Okay, so you are seeing it here, 7,450 minus the 3,950. And that one will be in the P&L. So in the subsequent year, so if 2019, okay, if 2019, we have revaluation gain higher than this 3,500, let's say 4,000, you come to the P&L, you credit the P&L. That means you credit the P&L by 3,500 to cancel the revaluation loss here from the P&L. Then the excess of what? 500 will go to the revaluation surplus. So it's in the notes. When you read it, you see the note I sent. When you read it, you will see. Okay, so this one, they just ask for the P&L extracts. Okay, they just ask for the P&L extract. If they added the statement of financial position, you know how to do that. And mind you, there will be retained earnings of what? 50. Okay. So please, do you have any other question? So there are past questions here. This one, they are readings. So this one too is determine the cost of an asset and all that. Okay. This particular question, okay, because we've not done IAS 40 and IAS 2, I'll leave it. When you get to investment property, you get some there to solve. Okay, so this one property, you can change it to what? Investment property. You can change it to what? Inventory. and you have to treat them according to the standards. Okay. So one property could be under owner occupied property, another one could be under asset that are held for appreciation, and also the asset that you are selling or you want to use for your production. So this last one, FR 2023, we will leave it after we are done with IAS 40 and IAS 2. You can try, but you get similar one in IAS 40. Okay. All right. So you see, one asset, it was PPE, it became investment property, it also became what? Inventory. That's why you are seeing from IAS 16 to IAS 40, then from IAS 40 to IAS 2. Okay, so please, do you have any other question? Hello.
No, please.
No, I don't have any question.
Question, board.
Okay.
Hello? No? Yeah, Pa, can you hear me?
Yes, I can hear you.
I mean, when my internet net costs I say you'll be
I was quiet. I was not talking. I was just looking for the other document. Hmm. Yeah, I'm coming. Let me stop this one. Open another working board. Oh, okay. So this one is just a short standard, and it's IS 40 investment property. And this one is a build up on the IS 16. As I said, PP is the mother of all asset standards. So investment property is a property held to earn rentals or for capital appreciation or both. Okay. So this one, as the definition, per the definition, an investment property is property, land, a building, part of a building or both held to earn rentals or for capital appreciation or both. So examples of investment properties are land held for long-term appreciation. So that's the main reason why we don't depreciate land. Okay. We know that land appreciates. Okay. So the price of a land at a certain area, a certain community in this year will not be the same as the amount. It will not be the same in what 2 years or even the next year. Okay. Land for which the future use is not yet determined. You have a land there, but you don't have you don't know what you are using it for. You don't know the purpose of that land. Okay, you haven't determined the future use of that particular land. And a property being leased to another entity under a finance lease. These are all examples of investment. Now, this lease something. Let's talk about the property leased within a group. So during consolidation, Yeah, we say we have the parent, we have the subsidiary. Sometimes we have the parent, we have the subsidiary, we have the subsidiary. Okay. So if a parent or an entity owns a property that is leased to and occupied by its parent or another subsidiary, we have two ways that you can treat that lease, okay, or that particular property. So let me use diagram here for you to get it well. So this one is IAS 40. Okay, so the topic that I want to talk about is what? Property leased to another group member. We know associate is not part of the group. Okay, it's not a member of the group. And the subsidiary, maybe two subsidiaries, they are all members. Parent and subsidiary, parent and a subsidiary, they are all members of the group. Okay, so let's first of all talk about that property, investment property, from the perspective the perspective of the owner of that property. Okay, so if it's the parent who owns the property, okay, how are they going to treat it in their own books and also in the books or in the consolidated financial statement? How are they going to treat it? Okay, so the one I want to talk about it was the individual financial statement. So let's say we have the parent, okay? Parents. We have a parent company and what? A subsidiary. And they are in a group. And the parent is having a building, okay? The property is building. Leads to this the subsidiary. Now, if the parent, say company A, is preparing their own financial statements, okay, they are going to treat that property in accordance with what IAS 40, because that one they see it as what investment property because they've leased that particular building to this subsidiary. And in this case, they are not parent and what subsidiary relationship because this one is individual. So company A has leased another entity the building. So let's say company B. So in the individual financial statement, they will treat it, okay, the property is treated under IAS 40 as an investment property. Okay. So for them, they will see it as what? Investment property. That's the individual financial statement. Let's talk about where they are in a group or they are preparing the consolidated statement of financial statement. Financial statement. Okay. Now, from the perspective of the group, the same property that is seen as investment property from the perspective of the owner, the individual financial statement. When you come to a consolidated one, it is seen as what? Owner occupied property. Okay, so here, under the consolidated financial statement, the same property will be treated as what? Owner occupied property under IAS 16. One will ask why. So let me add that answer. Okay. So this is the reason. Okay. So the property is treated as IAS 16 owner-occupied property when it comes to a consolidated financial statement, because the members of the group are seen as what? One undertaking, and therefore you cannot list to yourself. That is why those that we met for CR last night, we said that whenever there is intra-group transaction, whenever parents acquire loan from the subsidiary, we have to take out the loan, any interest and all that from what? The consolidated statement of financial position. So whenever there is a question, just ask yourself if they are asking from the perspective of the individual financial statement or from the perspective of the consolidated financial statement. Because how you are going to treat it under the individual's financial statement will be different from the consolidated financial statement. Because from the perspective of the owner, he will see it as what? IS 40, because they rented it out and they will be expecting some income. But from the perspective of the group, it is seen as what? Owner-occupied property. Okay, because it is used by the same entity or by the same group. Okay, so one will ask, what is this owner-occupied property? So we are saying owner or occupied property is a land or building or part of a building or both. And their main purpose is what? For the production of goods and services and also administrative purposes. Okay, so that particular property, the owner occupied property, you acquire that property mainly
Please,
for
can
the
you come
production.
again?
So I was saying that the owner occupied property, okay, is a land or building or part of a building or both. All right, that has been acquired mainly for the production of goods and services and also for administrative purposes. That is the owner-occupied property. Okay, owner-occupied property. And investment property too is investment property is a property, land or building or part of a building or both, held to earn rentals or for capital appreciation. Okay, so that's the main difference. Okay, so if you are asked to distinguish between investment property and also owner-occupied property, you can talk about what the purpose for which they were acquired. For the owner-occupied property, the main purpose is what? For production purposes. Okay, producing your goods and also your services and also administrative purposes. But for the investment property, that one is acquired mainly for what? Rentals and also long-term capital appreciation. Long-term capital appreciation. Okay, so this is what I can explain about that. Now you also have partly occupied buildings. This one too, let's say a company is having story building, okay? Let's say 5-story building or something, yes. And they are using just one floor for their administrative purposes. Okay. They are using one floor for just admin, or maybe There are 5. They are using 2 of the 2 floors for their administrative and other purposes, and they are using 3 for rentals. Now it's the same building, but the 2 that are being used by the entity for their administrative purposes will be treated in accordance with what? IAS 16 PPE. And the other 3 for rental purposes, that one will be treated in accordance with IAS 40 investment property. And we will solve a question like that, okay? Because we know or we've seen some entities or some companies, they have a store building. Sometimes you see store to let or something, or office to let, okay? So in the same tower or something, the company will be using some, and other institutions too will be using some because they've rented it from that particular company. So the part that they are using for their own administrative and production, or maybe production of goods and their services, that will be treated in accordance with what? IAS 16 PPE. And those that they've rented out will be treated under IAS 40. Now let's look at the recognition criteria for this investment property. So this one, the recognition criteria is the same as what? PPE 16. We are saying that if it is probable that future economic benefits associated with the property will flow to the entity. 2, the cost of the property can be measured reliably. So you see that it's the same as what? The that of what? IAS 16. The recognition criteria is the same thing. Is the same thing. Now, let me talk about the measurements. How do we measure it? Okay. How do you measure it? Now, the initial one, we are saying that you measure it at what? Costs. And we know what this one means. That one is the same as what? PPE. The cost less the accumulated depreciation. Then your answer will be the carrying amount. And that amount is what you are going to measure it in your financial statement. Okay. Now, let's look at the subsequent one. So this one, you have the option to choose between, okay? You have the option to choose between, you have cost model and also the fair valuation model. I hope you are seeing the difference between this one and PPE. So with PPE, someone should tell me, initially we measure it at cost. Subsequently, we measure it at cost model and what? We have option to choose between cost model and what? PPE.
Revaluation.
Hello. Come again.
I wasn't part, but let me try. Is it revaluation?
Thank you. Revaluation. Thank you. That's it. So the option to choose between what? Cost model and what? Revaluation. But IAS 40, you have the option to choose between cost model and fair valuation model. And the cost model is quite simple. That one, you know the cost, accumulated depreciation, you have your carrying amount. But the fair valuation model, that one, you use what we call the fair value. Okay, fair value. Now, this one, when you choose to go with this fair valuation model, we are saying that the fair valuation is done annually every year. So after that, I will come to the differences between fair valuation under IAS 40 and revaluation under IAS 16. There are differences. Now with the fair valuation, the changes in fair valuation are treated in P&L, but the revaluation differences were treated in where? Under what?
Statements of financial performance and other comprehensive income.
Yes, and
OCI.
thank you. And OCI, but this one, the difference is straight to P&L. There's no OCI. Because the revaluation, initially, it will be an OCI. When the loss exceeds the gain, that's where you send it to the P&L. But fair valuation here changes straight to P&L. Now with this one, the fair valuation, we are seeing that no depreciation charge for the year. No depreciation charge. So when you are using fair valuation and the IAS 16, you don't charge depreciation. So you just choose your fair valuation, you find the fair valuation difference. If it's a gain or loss, straight to P&L. You don't charge depreciation. You don't charge depreciation. Okay. And this is the definition of what fair value is. A whole standard. You treat it IFRS 13. You treat it and you get to appreciate it. So the fair value is defined as what? The price that will be received to sell an asset or pay to transfer liability. So this definition will be there. And when we get to IFRS 13, you appreciate it well. Okay, you appreciate it well. So I said I wanted to write the differences, but I think I've said enough. You can make your own note. So under IAS 16, that's revaluation. Yes, the revaluation is not done annually. That one is done periodically because we said that the revaluation is not done periodically. Okay, that one we do revaluation in reference to the volatility of what the fair value, how the fair value changes, or how frequent that the fair value changes. That's where we also do the revaluation. Okay, to reflect the fair value. Yes, the market value. All right. But for fair valuation and the IAS 40, that one, the valuation is done annually. Every year, you have to revalue the asset, fair value the asset every year. At the end of every year, you have to fair value the assets. Okay, that is the first differences. We can also talk about the depreciation and the IAS 16. Okay, PPE. We don't revaluation, we charge depreciation. But under IAS 40 fair valuation model, we don't charge depreciation. But for IAS 16 revaluation model, we charge depreciation. Let's talk about the changes. Now, changes for under IAS 16 PPE revaluation. The changes is treated under OCI. It will appear in the P&L where the revaluation loss exceeds the previous revaluation gain in respect of for the same asset. But for fair valuation model under IAS 40, the changes, okay, whether fair valuation gain or fair valuation loss is treated straight in what P&L. So the same way we're determining revaluation gain, revaluation loss, that's the same way we are going to determine what fair valuation gain, fair valuation loss. All right. I think I've done the explanation. Okay. I think I've done the explanations, the differences. Okay. So let's look at transfers. So there was one question under PPE that I said we've not done IAS 40, we've not done IAS 2. So when we treat this one, go and try the last past question, compare it with the answer. Because there's a question here we solve that is similar to the past question. Now let's see, transfers to and from investment property can only be made if there is a change to the use. Okay, this one is very important. So let's look at where the asset has been transferred from investment property to owner-occupied property. In simple words, the asset has been transferred from IAS 40 to IAS 16. How do you treat it? It was initially an asset that you were expecting some appreciation, or maybe the future use is not yet determined or something. Yes. And we've transferred it towards owner occupied property. Now that property, we are not renting it again. we are using it for our own production purposes. We are using it for our own administrative purposes. So that one is transferred from investment property to owner-occupied property. How do we treat it? You apply IAS 40 up to the date of reclassification. So if the date that they change the investment property to owner-occupied property is, let's say, 31st December 2017, okay, you have to apply IAS 40 from the date that they acquired the assets or they completed the assets or they acquired, let's say if it's land, the date that they acquired it, okay. If it was, let's say, 1st January 2015, you have to apply IAS 40 from this date to 31st December 2017. And on that date of reclassification, you still use fair value. So as at the 31st December 2017, you still use IAS 40. But subsequently, from the 1st January 2018, you apply IAS 16. So you apply IAS 40 up to the date of reclassification. On the date of reclassification, you still use the fair value, that is IAS 40. Now, subsequently, you use IAS 40, 16, that's PPE. Please, I hope that part is clear from investment property to owner-occupied property. Is that part clear? Is that
Kindly come again.
okay? So let's take a land, for example. Let's say initially the land was treated under IAS 40 and the land was acquired on 1st January 2015, just 2 years ago. And in 2 years' time, 3 years, because the whole of 2015, the whole of 2016, and the whole of 2017, because the year end of 2017. So 3 years' time, they want to transfer the land from investment property to what? Owner-occupied property, that is IAS 16. Now, you apply IAS 40 from the day that they acquired the land, that is 1st January 2015, to 31st December 2015. And even 31st December 2015, you use fair value, that is under IAS 40. But subsequently, from 1st January 2018 going, you apply IAS 16. What do you mean by you apply IAS 16? Initially, you are using IAS 40. Let me use different asset, building, okay? When it was under IAS 40, you were not charging depreciation because under IAS 40, you only deal with fair valuation. You don't charge depreciation because that's one of their characteristics, okay? You don't charge depreciation. You just fair value it. But subsequently, you want to change to IAS 16. So from 2018 going, you will charge depreciation. So up to the date of reclassification, you use the IAS 40. So the time that you acquire the building, up to the date that you reclassify the assets to reclassify it as what? Owner-occupied property, you will use IAS 40.
Okay.
But from that date going, you will use IAS 16. Please, you understand?
Yes, please. Thank you.
All right, so that is the first scenario. Let's talk about from investment property to inventory. Now, this one, most at times, there's one common example here. The real estate, okay? You know, real estate, building can be an inventory for a real estate company. Do you know that? Hello?
Yes, please.
Yes, please.
I'm asking that the real estate companies, you agree with me that the building, okay, can be inventory to those real estate companies. Do you agree with me?
Yes.
Because that's their ordinary course of what business. But they sell they deal in what buildings. So let's say you have initially you were having a building that you were renting out. Now you want to transfer or convert that building from investment property to inventory. Now you don't want to lease out, you don't want to rent, you want to sell. So it's now part of your inventories. So now you are transferring it from investment property. So here you are transferring it from IAS 40 to IAS what 2. So this one too, you are saying that use the fair value at the date of change. And for subsequent periods, use IAS 2 inventory. So you don't get confused. We will use questions and you will understand. Now, let's talk about the transfer from owner-occupied property to investment property to be carried at fair value. So this is where you have an asset under PPE. This one, you are using it for production and administrative purposes, but you want to convert to what? Rentals. You want to rent it out so that you get something on it or for capital appreciation. That's what I mean. So normal accounting under IAS 16, that's the cost less your depreciation, will have been applied up to the date of the change. So again, if you have a building, okay, from you acquired a building on 1st January 2015, and you want to reclassify the building from ISP 16 PPE to IAS 40 investment property, what you are going to do is that you apply IAS 16. So you'll be charging depreciation up to the date that you want to reclassify the asset to what? Investment property. Okay. Now, on adopting fair value, there's normally an increase in value. This is recognized as other comprehensive income and credited to revaluation surplus in equity in accordance with what? IAS 16. So whenever there is revaluation gain, revaluation surpluses, we know we treat the revaluation gain in what? OCI. So even on that date, you compare and see what whether there is a revaluation surplus or loss. Then you know how to treat it. Then subsequently, you treat with what? The IAS 40. So that one, what you are going to do is that you compare the carrying amount as at that date and the fair valuation. Okay. Then whenever there is increase or decrease, that one will be treated as what? Fair valuation loss or gain. All right. So please, I know maybe it will be confused, but let's look at this example and see something. Okay. So after class, I'll send you the document, and for the standards, if you want to understand it well, you can also sometimes download the IFRS document from the IFRS website and you read to understand. Because I've been telling you, CR is what? 30%. The standards is 30% out of the 100 marks. So yes, and this one excludes sometimes the consolidation. You need the knowledge of what? 2 standards at least to solve the consolidation in corporate reporting. So if you add that one, it's almost 35 marks or 33 marks of the whole 100 marks. So CR is on your, so please, it's on your standards, and you don't know the standard that is coming, both level 2 and 3 standards. Okay, so please let's read this particular illustration. That is illustration 1.
Illustration 1. Junior May Enterprise owns a property which it rents out to some of its employees. The property was purchased for 30 million Ghana cedis on 1st January 2012 and had a useful life of 30 years at that date. On 1st January 2017, it had a market value of 50 million. And its remaining useful life remained unchanged. Management wishes to measure properties at fair value where this is allowed by accounting standard required. How should the property be treated in the financial statement of Jinyame Enterprise for the year ended 31st December 2017?
So this one, are we using IAS 16 or IAS 40?
IAS 40.
Okay. Why? And if anyone is having another answer or maybe alternative solution or answer, that person too can bring it out. Okay, so please, why IAS 40? I want to know if you guys are following. The explanations I made. Yes.
Based on what I read, it says it rents it out to some of its employees. So that makes it an investment property. And then also it's being measured at fair value.
Okay. So that is okay. But look at this. You are saying that property leased or rented to what? Leased to another entity under finance lease. Here, that statement will try and confuse you, but it's rent out to some of its employees. And employees is not outside the company. Okay. So this one, it will still be treated as IAS 16. See, the property is rented out to employees, is deemed to be owner-occupied property, and therefore cannot be classified as what?
Okay.
Investment property. Okay.
Okay.
Yes.
Right.
So if they say that it as rents, which it's rent out to maybe another company, that one there, you are good to go to treat it an IAS 40. So this one, let's look at the treatment. So here we have the costs. Okay, the costs. So the cost was 30 million. Okay. And we have to calculate accumulated depreciation. It's IAS 40 though, but we are using IAS 16 here because this one cannot be classified as IAS 40. Now, 30 million divided by, so we are saying that the property was purchased for 30 million on 1st July 2012. Okay. Now, the valuation, the market value here can be revaluation, was on 1st July 2017. So from 1st January 2012 to 1st January 2017 is how many years?
5 years.
5 years. But if it were 1st January 2012 to 31st January 2017, that one would be how many years?
12, 13, 15, 16, 6 years.
6 years. Thank you. So sometimes it can be the same 2017, but look at the month. Okay. If you don't take care, so it's like 1st January 2013 to 1st January 31st December 2014. If you don't take care, you say that this one is 1 year. No, it's 2 years. Because from 1st January 2013 to 31st December 2013 is 1 year. And also 1st January 2014 to 31st December 2014 is another year. So please, sometimes let's look at the month and all that. Good. So this one is 5 years later. Okay. So the useful life was 30 years. Times what? 5 years when we bought it. From when we bought it to the fair valuation date. Okay, so please, what is the answer? Is it 5? Yes. 30 over 30 will be 1 times 5, so 5. The accumulated depreciation will be 5 million. So the carrying amount as at the 1st January 2017 is what? 25 million. And we know revaluation happened on what?
1st January 2017.
So 1st January 2017. So 50 million. So we are good to go to know our revaluation. Definitely revaluation what gain 25. Okay. And the question is saying that how should the property be treated in the financial statement of Jin Yami Enterprise for the year ended 31st December 2017? So this one is not as at the reporting date. This one is the beginning of that report year end. So we have to calculate, move on to calculate the depreciation for the 2017. Okay. So the cost will now tend to the revalued amount. That will be your base, 50 million. Then depreciation for 2017 will be the 50 million divided by what? There is no extension of useful life, so we use the remaining useful life. It remained unchanged, so it was 30 years. We've used 5 years out of it. Okay, so it left to 25. All right. So this one will be how many years? The amount will be what? 2 million. Okay, so the carrying amount as at the 31st December 2017 will be 48 million. Now let's look at the extracts. Let's look at the extracts. So first of all, P and L extracts. P and L extracts. Okay. So for the 2017 depreciation is 2 million here. So we not talk about the depreciation, the accumulated one. No, we want the year in question is 2017. So we will choose only this one. 2. OCI. You talk about the revaluation surplus or gain. And that one is 25. Because this one is still in 2017. So 25. Then SOFP, NSA, okay, PPE. So you value it at what? The revalued amount. Yes. Then equity component will be the revaluation surplus of what? 25. Please, are you okay?
Yes.
Okay.
Yeah.
Okay, so let's move on to I don't know what I say. The answer is fine. So let's move on to this illustration too. Hello. Any fast, Anna? It will be IS40 before we close. Please read it for me.
Okay, illustration 2. Ibuakwa owns the following properties as at 31st December 2015. We have property, land with future use undetermined. Then we have factory rented to Ibuakwa's subsidiary under an operating lease. 10-floor office building. Fair value is equal per floor with 3 floors used as the subsidiary's head office and 7 floors rented to third parties under an operating lease. Then we have empty building held for capital appreciation but not leased out. So Ibuakwa's accounting policy is to hold its investment properties under the fair value model and its land and building under the revaluation model. Required in accordance with IAS 40 investment property, calculate the carrying amount to be recognized as investment property in a Boaquest consolidated financial statement as at 31st December 2015.
Okay, thank you. So let's do it together. So the first one, are you going to recognize it under IAS 40? Does it qualify? Does it mean the recognition criteria? I'm asking you, are doing it together?
No, IAS 16.
Is that
IAS 16.
any answer?
The first one is IAS 14, second one is IAS 16.
So then I was asking about the first one. So the first one qualifies. So land with future use undetermined. 3.2. Now the second one is the one I explained. So this one is your subsidiary. So you cannot treat it as what investment property. You treat it as under what IAS. So this one is out. 10th floor office building. Fair value is equal per floor. So every floor, the fair value is the same with 3 floors used as the subsidiary's head office. So this was the example I was giving. And 7 floors rented to third parties under an operating lease. So how much are you going to recognize as investment properties? Yes.
The 7. The 7 floors rented to third parties.
So that one will be 7/10 times the 15 million. So please, what will be the answer?
7/10 times 15. 10.5. 10.5.
Okay, so this one, 10.5 of it. Empty building held for capital appreciation but not leased out. Are we adding it?
No, I don't think so.
Yes, that is view. Hey, where for? As any time you know, being a 5 was the same crowd.
I think we should add it.
Why? And the one who said no, why? Well, I want to know if you really understand. Yes, make us go.
You mentioned that with investment properties, the properties are held for rental income or capital appreciation, if I heard you right.
Yeah, so please, when you see capital appreciation, you have to add it under
Okay.
IAS.
Okay.
So this will be your figure. This will be your carrying amount for the investment property. And this was a past question. Simple as this. So if you don't know the rules or the principle, so please, what is the carrying amount?
That's 17.8.
17.
0.8.
Okay, so let's treat illustration 3 and 4. First of all, let's finish this illustration 3 if you have time. Then we do 4. And
Okay.
the rest are just disclosures. Disclosure, then yes, then to the past questions. Okay, so this was a past question. Another past question here. Okay. So please let's do this. Illustration 3, someone should read.
Okay, illustration 3. Kumari Limited is a real estate company which operates under International Financial Reporting Standards, IFRS. The office building of Kumari had a net carrying amount of 80 million at the beginning of the financial year, 1st January 2019. The property was held under the cost model, as its residual value estimated at more than its cost due to a buoyant property. Is it property market? Okay, buoyant property market. No depreciation had been charged. As part of a relocation of the company's business, the property became vacant and was leased out to a third party on 1st April 2019 under a 6-month short lease. At the time the property was leased out, its fair value was 22 million. At the end of the lease, the company decided to transfer the property to its inventories of property for sale in the ordinary course of its business. At that date, the value of the property was 21 million cedis. The property was sold in December 2019 for 21.3 million cedis. The company uses the fair value model for its investment property. Required: determine the amount to be recognized in profits or loss and in other comprehensive income in respect of the property for the year ended 31st December 2019.
Okay. So please, someone should tell me. This one is transfers. They did 2 transfers. So someone should tell me from what to what and to what. They were 2. From one standard to another standard. Then from the middle standards to the third standard. So it was like this. It transferred to this standard and they transferred to the last standard. So please, someone should tell me the first standard. Hey, I the moment my call. If you don't talk 9:30, boy, I'm upon.
Can you hear me? My network is bad. I don't know if you can hear me.
Yes, you can hear you.
I think the first one is IAS 16.
Thank you. So IAS 16. 2.
To IAS 40.
Thank you. 2.
IAS 2.
IAS 2.
Yes. So as I said, this one is the same as the past question you saw. And IAS 16. So you solve this one on your own. Try and solve that one compared to the answer. Okay. It's not difficult. Yeah, so if you know the standard, you can do it within a short possible time. Okay, so this one is from IAS 16 to IAS 40 to IAS 2. Okay, so let's start with what? The PPE. So the carrying amount. Okay, the carrying amount, although this is not the cost, but that is the carrying amount. That one is at what? 1st January 2019. And that one, let me hold the millions here. That one is what? 18 million. Okay. That one is 18 million. They said that no depreciation had been charged, although they uses cost model, but no depreciation had been charged. Okay. So you look at the fair value. So as part of relocation, so the company was trying to relocate, and that property became what? Vacant, and was leased out to a third party, not a subsidiary, on 1st April 2019 under a 6-month short lease. At the time the property was leased out, its fair value was what? 22 million. So now, fair value. So this one you can call it revaluation amount, because we are treating as what? We are treating it as PPE. So let's call it revaluation. So revaluation or revalued amount. Let me write revalued amount. Okay. Then we just find the difference. They said that no depreciation had been charged. The moment you see no depreciation had been charged, you don't have to worry yourself to find depreciation. So the difference will be the revaluation surplus of what? 4. And we know that double entry is simple. You debit the PPE, okay? In this case, that particular asset with 4 million, you add that 4 million to the amount. So when you go to PPE, add plus 4, okay? Then you credit the OCI, other comprehensive income, you credit it with also the 4. Okay. Now let's talk about the investment property. Now the investment property, the property was leased out. Its fair value was 22 million. So the investment property, the fair value, okay, under the investment property is what? 22 million. So you choose the revalued amount, that amount, this one. So the ending of PPE amount becomes the starting point of what? The investment property. So I told you that on the date of reclassification, use the previous standards and subsequently use what? The new standards they are transferring to. So now it's like the thing I drew, okay? The IAS 40, this one is 16, first one was 16. Transferred it to what? IAS 40. So the ending point of this place, okay, becomes the starting point. So that's why we are seeing 22 million was the revalued amount. When you are starting investment property, you start with that 22 million because it was revalued, it was fair value to what? 22 million. Now let's see. At the end of the lease, so after the lease, the company decided to transfer the property to its inventories of properties for sale in the ordinary course of activities. At the date, the value of the property was 21 million. So the date that I've told you that under fair valuation, IAS 40, there is no depreciation. So straight away, you check your fair value, okay? The fair value that they changed to inventories. That one was for 21 million. So what is the fair valuation? Gain, the difference. Is it gain or loss?
There's a loss of 1.
Thank you. So this one too, the double entry is simple and straightforward. You are saying that this one is not revaluation. So this one, the difference, whether gain or loss, treat it in the P&L. So this one is loss. That means you debit P&L. If it is gain, you credit P&L. So plus debit P&L 1. Okay. Then investment property, they are reducing by 1. So the corresponding credit will be the investment property. 1. All right. Let's look at when it was changed to inventories. Now, what will be the starting point for inventory? Who can tell me? What amount? What?
21.
21 million. Thank you. So this one, the fair value was 21 million. And they said that they sold it for what?
1.3.
So profit on disposal.
21.3.
So are they making loss on oh sorry, this one is sales proceeds. I've already written the answer. Okay. So please, are you getting profit or loss on disposal?
Profits
So
of
profit
0.3.
of what?
0.3.
All right. Please, is it difficult? For now, maybe it might seem difficult or something, but after class, get time and go through yourself. Let's discuss the last one so that we close. Illustration 4. Illustration 4, please.
Junior May Enterprise owns a building which it has been using as head office. In order to reduce costs, on 30th June 2019, it moved its head office function to one of its construction sites and now letting out its head office. Company policy is to use fair value model for investment property. The building had an original cost on 1st January 2010 of 250 Ghana cedis and was being depreciated over 50 years. At 1st July 2019, its fair value was judged to be 350,000. At 31st December 2019, the property was fair valued to 380,000. How will this appear in the financial statements of Junior May Enterprise at 31st December 2019?
So who can tell me this one to the transfers? From what to what? This one is just to
PP
to
so from IAS 16 to IAS 40.
Thank you. So let's look at the costs. Original cost of the building is what?
250,000.
250,000. Thank you. So 250. So we will calculate depreciation because first one is under PPE. So 250. The building had a useful life of what? 50 years, right?
Yes.
Now who can tell me the accumulated years? I want to see something.
January 11, 12, 13, 14, 15, 19, 8.5.
Yeah, close.
18, 10, 11, 12.
I think 7.
Hey, what's from crap?
8 years, 6 months. Or
What? Kawako.
Akabako.
So 9.5 years. 9 years, 6 months.
Yes, it's true. Hey, you're a dinner,
So the whole of 2010, 1 year. The whole of 2011, 2. The whole of 2012, 3. 2014, 4. 2015, 6. 2017. And so 2010. The whole of 2010, 1. 2011, 2. 2012, 3. 2013, 4.
Yeah.
2014, 5. 2015, 6. 2016, 7. 2018, 8.
2017, 8.
Yes. Then 2019, 9. Oh, I don't remember. Let me do it like this. So 10, 11, 12, 13, 14, 15, 16, 17. 1, 2, 3, 4, 5, 6, 7, 8. So this one is 18. 1, 2, 3, 4, 5, 6, 7, 8, 9. Have you seen it? Up to 2018, 9. But when the they moved from the head office, okay, it was what, 30th June. All right, plus that half. Have you seen it? Because you
Okay.
have to determine the
Yes.
carrying amount to the date that they reclassify the asset to different standard. So sometimes, a banner is in here, use pencil because adults now use two fingers, never phone. So I use pencil like how I've illustrated on the board. So the whole of 2010 to 2018 is 9 years. So the accumulated depreciation, you can do it 9.5 years and just get your answer. But when you are preparing the extracts, you will need the depreciation for 2019 alone. That is half of the year. So whenever the reclassification was in the middle of the year, first of all, prepare it from the original one to the year end. Then prepare the half separate because the half is what you are going to show in the extracts. I hope you are getting my point.
Yes.
Okay, so times 9 years. That is up to 2018. Then you do the half separate because the half is what we are going to use in our extract. So times 9 years. Is when me and 930 now.
45.
So the carrying amount. So this one will be carrying amount as at what date? Let's see something.
As at 1st January 2019.
Thank you. It's 31st December 2018, but that one is the same as 1st January 2019. Okay, so please, what is the amount here?
205.
So you have to calculate depreciation for that half in the 2019. Okay, so that one will be the cost of the asset again over the useful life of 50 times half or 6/12. Hope you are not confused.
2.5.
Because if you do it 9.5 straight away to get to the 30th June 2019, how are you going to determine the depreciation component for 2019 alone? Have you seen it? That's why we did the half separately. So the carrying amount we are going to get will be as at when?
As at 1st July or 30th June 2019.
30th June 2019. It's the same as 1st July 2019. Okay. It's the same as. So that one too. So this one we are getting 202.5, right?
Yes, please.
Okay. So the building was fair valued to 350. That is what at 1st July. So 1st July 2019. It was fair value to 350. Okay. So this one, because they've converted it to IAS 40 in the year 2019. The difference is fair valuation difference. It's not revaluation. Because in the year 2019, or from that period, okay, when they converted it to IAS 40, you are using, they converted it to what? Investment property. You know that you are using what? Fair valuation model. And fair valuation model, there's no depreciation charge. And also, the differences is what? Fair valuation loss or gain. And that one will be treated in the P and L. Okay. So please, are we getting fair value gain or loss?
Fair value gain.
Of
147.5.
okay, 147.5. Okay. Oh, sorry. I think this one will be revaluation rather, because still we are still in PP. Sorry for that one.
Okay.
So this one you can call it revalued amount. So let me leave. So this one will be revaluation surplus. Okay. Now let's go to the real fair value adjustments. Okay. So with this one, let me start from here. At 31st December 2019, the property was fair value towards 380. Okay. So the PP ended on what? 30th June 2019 or 1st July 2019. And the ending point of PP become the starting point of what? Investment property. So the investment property here was PP. Will start from what? 1st July 2019. So the carrying amount, okay, or the fair value was 350. Now it was fair valued, that is the 380, 31st December. So fair value 31st December 2019. So the remaining of the 2019 will be treated under fair valuation. So this rather will be the fair value gain. And that one will be the 380 minus the 350. That's giving us what? 30. That is giving us 30. So let's look at the extract. Okay. Let's look at the extract. P&L. Okay, so the P&L extract. We start with the depreciation. So the depreciation, as I said, you need the half component. So if we added the 0.5 here, we got the whole figure. How will we determine the half from the 1st January 2019 to 30th June 2019? That's why we did half separately. Okay, so depreciation 0.5, negative figure. Then the fair value gain, straight to P&L, a 30, positive figure. Then we go to OCI. And OCI will contain the revaluation surplus of 147.5. Okay. And in the statement of financial position, that one, the PPE will be, or the investment property, okay? The PPE will be the investment. So let me say investment property, because now it's not PPE again, it's investment property. So what will be the figure? How are we going to measure it?
380.
380, thank you. Then the equity side will change, will have the revaluation surplus of 147.5. Okay, so the rest are disclosures. So what you need to disclose in your statement. Then you have the past questions here. Okay, so please think this one. I don't know if you are tired or you didn't understand some of them, but after class, just revise and also try your hands on the questions, and I think you'll be fine. Okay. So please, any question for me before we close? Okay, so please, host, can you pause the recording for us? I want to say something.